Look at that.
Hey, all right, we are live.
We're live. It's early fall, it feels like out here. It's nice, man. I don't know about you.
It's pumpkin spice. I'm not a fan of this weather. I could use summer all year.
Pumpkin spice, everything nice. You're not a sweater weather guy?
No, there was actually a the National Weather whatever put out a pumpkin spice warning for Northwest Indiana and Chicagoland last week. So
run to Kohl's, get your Uggs, get your black spandex leggings, and your pumpkin spice, huh?
God, I'm not looking forward to it. But either way,
I wasn't sure. I figured as a hot-blooded Italian that maybe the 74 and no humidity would be something you like, but
no, because I ride motorcycles and I use them as transportation often. And this time of year, you basically have to pack all of your clothes with you for everything and come out of a restaurant at night and you're like, oh, it's winter now.
That's why you buy a bagger, right? Bring them all.
And I have everything stuffed in there all the time. So anyways, it is what it is. We're going into this fall market, man. I don't know if it's happening with you, but we've picked up really big time. So I think we're going to have a really busy fall here.
Applications up heavily. I did see a couple of interesting stats, and I think they were maybe published by Realtor.com or something along those lines about inventory in the Midwest is some of the tightest inventory in the country right now compared to the Southwest and the Southeast. What does that mean? Good houses are going to go quick, so be ready to buy.
Yeah, we still have, I just got it, as client we're working on, we just got her under contract and we pulled up a rather large market area in a rather large price range. And I think I had a list of probably 8 properties that just fell into it. I'm not talking about 8 properties that we wanted to see. And then out of those 8, I think there were 2 that we wanted to see. And then there was so buyers, it's the same thing we've been saying for a number of years. They have to get in that poised and ready position and get in our system so that we're ready to pounce when something comes available. That may come available today. That may come available in 6 months. But we have to have you ready to go and ready to pounce. And a lot of people miss out because they think that they can just, hey, here it is. It's Tuesday afternoon. Well, you need to see it by 4 because there's multiple offers and you're not ready to go.
That buyer that you just referenced, that we've been working with her for 15 months.
Yeah, which is fine. We would rather have that, right?
Well, we knew, right? She had to get a house ready to go, to get to bring it up to sale, bring it to market, time everything up. But she knew right away, 15 months ago, she knew the budget. She knew. So when the time's ready, right, and you're scraping all of that data, we go, all right, we got 8 properties that fit the parameters and only 2 or 3 look all right. It is what it is. We got to go to market we got to see what's at the market when you're ready to go to the market. But if you don't have an understanding of the budget and your exit strategy or your other goals, you're going to swing and miss.
In this one, actually, so I just wanted to touch on value of using an experienced agent in the market and experienced people in the market, because this one in particular worked really well. So we had to sell their house. We got their property under contract with an agent who at one time, I think it was actually her managing broker, but big dog, big name agent in the marketplace who I'm very familiar with. So we were able to work together. She trusts me. I trust her. Put together something that worked for the client, understanding their situation, which that probably wouldn't happen the way that it would if it was just some agent that's knocking down 3 deals a year that we don't know. All right. And then when I hit the field with my client, we actually found some new construction that the company that builds the houses was familiar with you and your team. So this is the second one in 2 months where we were able to get the buyer under contract, largely because either the listing agent or the owner of that property was familiar with your team. The one that we did 2 months ago, actually, it turned out that the seller was actually using your guys' team for his own financing. We had no idea. So they were super happy to see your name. So we were able to work some things out that I think in a lot of other transactions, you probably wouldn't be able to. So getting ready to go, but also doing it with somebody who's really experienced in the market. People know the name, and then everybody has a lot more comfort.
It's the biggest thing. We talk about the percentage, the percentage chance of this transaction closing as designed, right? Or everything falling into place perfect or within a very, very narrow band. And so in these clients' cases, right, we know we talked about this before too, the inputs and the outputs, right? We know what the property is going to sell for. We know that the borrower, or that case, the seller, your seller, who's also your buyer, my borrower, we know what's going to come in at closing to deploy towards, in her case, down payment, closing costs, and then also knocking out some high interest debt that came up, because we're not going to look at the monthly payment. We want to look at your total monthly budget and figure out that $5,000 here maybe knocks out $184 a month, whereas $5,000 more in your mortgage knocks out $35 a month.
Exactly. It was a whole like super well-rounded solution, and everybody knowing everybody and feeling comfortable and able to trust them, like, made some things happen that I think don't happen in regular transactions where your name isn't known of the person, the trust isn't there from the other side and whatever. So that's working out really nicely.
Well, let's talk about the poison ready thing too. This came up, it was not one of your buyers, but this came up yesterday and into this morning here with the buyer. Buyer works for a large corporation. They have use the corporation mortgage referral source. Sure. They get pre-approval. They get under contract to buy a house. That loan officer that they were working with through the corporate mechanism kind of just disappears, doesn't answer questions. And these people end up on my doorstep under contract with 2 weeks left. And here's the craziest part. Open up the conversation, like, hey, let's talk about what's going on. Like, your payment goals, and like your payment's going to look like about $2,100 a month. And you just heard crickets. Yeah. And I was like, we're this far down and we don't know that the payment's going to be about $2,100 a month. And they're like, we thought it'd be $1,500.
Right.
And I was like, that principal and interest? No.
That's a non-comprehensive initial buyer consultation.
Correct. And this is what goes on a lot of times when you use these online places, is they just, here's your $250,000 pre-approval, Mr. Mitidiero.
Right.
No conversation about payments, cost, market cost, all of that. And so now these people are going to they're recalibrating because they don't want to buy the house because no one told them that. And I was like, within 15 minutes of our conversation, I told you what your payment was going to be.
Right.
Those are the things with being poison ready, right?
Yeah. Readiness is huge. And today, and I think this is going to go on, I'm hearing some things, and I have a tendency to believe them about what we can expect for the economy in 26. I think we're going to really start to see the economy start to take off. And I also think maybe rates stay the same or maybe move down a little bit. But when the economy takes off, I think it's going to probably tighten up inventory a little bit further. I think we'll see more people get in the game and we'll have a higher transaction volume. But this whole be ready to go thing is not going away anytime soon. Yeah.
So let's talk about being ready to go. The other part of being ready to go is, hey, this salad is fine. These people are repulsive. They smell. So let's talk about some things that have come up, right? When we're in this weird market where it's gone from like heavy seller market and buyers really trying to compete to a little bit more back in balance, but probably going to pop a little bit back more towards the seller market at some point here. Buyers, especially in a little bit higher of a rate environment, may or may not try to get a little goofy or a little wonky here. Ideas that things that we've ran into here that are horrible ideas. One of them, it's on full on broadcast right now from Pulte and the guy in charge of Fannie Mae and Freddie Mac. Occupancy fraud.
Yeah.
A massive issue. If the guy that's in charge of Fannie Mae and Freddie Mac is putting people on blast left and right,
they're going to be looking. They're going to be looking at you. If they're doing it with high profile people, it tells me that they now have some mechanism in place. I don't think they had a very good one for a long time. And obviously you could get away with it right and left. But I think the police have arrived, right? The police and the FBI have arrived and they're investigating the crime scene.
Yep.
So these days, I think you're going to really have to watch that. But when we talk about this, where does this come into play? Because actually I talked to somebody yesterday who was saying, oh, when we were doing this, this property in Indiana, it was an Illinois family. They're like, we didn't realize it was a second home, and that came up along the way and it changed things. So how does that impact things?
So it was going to be their second home or what?
It was, yes. It was, no, the buyer who was buying the property from them got tagged along the way. Now, they weren't using agents and weren't using attorneys.
Okay.
All right. So they didn't have any professional guidance. They're like, yeah, this thing came up in the middle and we thought the buyer was lying, but then we found out that it was legitimate, that it was either a second home or an investment property for them, and it changed their parameters along the way.
All right. So a couple things that go on with that. A conventional financing, your minimum down payment on a second home is 10%. Your minimum down payment in other cases in a primary residence conventional can be like the lowest can be between 3% and 5%.
Okay.
So that's part one of that equation.
So it is affecting the down payment.
Yes, which is, it is what it is. Like that's one little trip hazard.
Okay.
The next part where this starts to get explosive is if you rewind back to about 2 years ago, there was this huge hoopla about this Fannie Mae and Freddie Mac and this matrix, and these people with these credit scores were going to get, the people with good credit scores were going to get walloped and all this stuff.
I remember that.
Well, one of the biggest changes in there is that Fannie Mae and Freddie Mac put these adjustments to interest rate and your cost on second homes that mimics or is very, very similar to an investment property.
Right.
So now if you're going to go second home with 10, minimum down payment, so 10%, you're talking about a massive adjustment in interest rate or cost.
So payment is going to go through the roof, or not necessarily through the roof, but payment's going to change substantially. So you have to be aware of that.
Correct. And then the next part is, so let's move down one further step in the second home to investment property situation. So investment property, single family investment property, minimum down payment's 15%. I know that sounds crazy. Again, that's only on a single family. That, again, multiplied by PMI because you're not putting 20% down, and then these matrices creates a whole line of chaos of increased payment, increased down payment. But then the last part is Fannie Mae and Freddie Mac have this thing, the word reserves, which sounds scary. You don't have to pledge these, you don't have to put them up with the bank, but we have to look at your liquid assets and go, okay, in this case, your mortgage payment's $3,000 a month. Well, we need to see that you have 3 months of reserves. So we need to see that you have $9,000 of liquid assets
after you close. We need to see you've got the money for the down payment plus 9.
Yes.
So that's
probably where that's probably what tanked it, right? So now you got to move to, maybe you're at 5% down and now you're at 15 or 20% down. And now you got to come up with the reserves. Well, guess what you can't do? I had this conversation with someone yesterday. You can't use your 401k for reserves on a second home or investment property unless your plan summary says that you can access your 401k funds whenever you want. And that's not the case because 401k typically a tax sheltered account. So you can only use it for your primary residence.
Wow. Okay. Yeah. So that's why it's historically been very tempting for people to say that a second home was actually their primary residence, right? And for years, we didn't really see anybody getting in trouble for it. And now we are.
Yes. For a variety of reasons. One of it's like, we talk about AI and technology and scaling. In Indiana, I found this out when I built my house and moved over here. I had to get my driver's license before I could file for my homestead exemption.
Right. Yes.
So now all of a sudden, what happens when you see these driver's licenses don't make sense, or this thing doesn't make sense, this thing doesn't make sense. Loan servicers are getting return mail for their mortgage statements going out. It raises a red flag. And as you'll see, if you follow Pulte on X or whatever other things he posts on, he's a little bit off the rocker on publishing some guidelines that maybe aren't accurate. But again, they're researching this. I promise you, they found that stuff on that Fed governor in about 2 seconds.
Yeah.
It will come back to you.
The ability to crunch large amounts of data has increased exponentially in the last 3 years, 4 years.
I could tell you right now that 2 nights ago, I was able to retrieve every tax bill in Lake County, Indiana, with the mailing addresses in 39 minutes.
Wow.
And turn it into a spreadsheet that I can now sort by zip codes.
This is so yeah. So I mean, I think everything is being much more so watched today. And I've had the conversation with people. I'm like, I don't think it's not worth it to even risk it. Like, historically we'd be like, are you going to get popped? Like, I don't know. Like, I don't actually know anybody who has been, but now it seems like you could be. There's
other consequences. We'll talk about this one real quick too. Other stinky things that happen. And there was a prospective home buyer recently, who actually he got fired because he was sending in fake pay stubs.
Okay.
And then he used his company's letterhead and wrote a letter.
Oh boy.
And that unfortunately, like, part of the process was verifying and us following up with the employer saying, hey, is this letter legitimate? Like, this person who signed it, their phone number is not in your call directory. This email address is at Gmail, not a suffix. And like, we follow up and they're like, well, hold on, what happened here? And it's like, well, this guy sent us this letter. This isn't valid.
Yeah.
No. So like, there's again,
and that's mortgage fraud, and I don't think people realize how big of a deal that is. Like, you
sign a disclosure in our loan, and every mortgage company's loan package with a giant FBI logo on it that says that making a statement that induces us to lend you money that's false is punishable by up to 30 years in prison and $1 million fine.
Well, so I mean, having had the experience and having gone through the recession. Prior to the recession, there was a whole bunch of mortgage fraud, and a lot of that stuff got found out along the way as we were coming through the recession. And actually, there's two people that I'm thinking of right now. One was in the southern suburbs, one was in Northwest Indiana, both fairly well-to-do guys who got nabbed afterwards, and both of them went to jail. Each one of them got a 1-year sentence. So,
and that was before,
that was before we were really looking at it. Now, these guys were each pretty brash abusers of it. All right. It was pretty blatant what they were doing, and they got nabbed. But that was in the era where they had very little controls on these things. And now we can really kind of see what's going on.
It's a wild thing. Again, like, having the conversation and just having the honest conversation with people, it's critical. Watching what people do on TikTok and Instagram. I think we were talking before too about like that guy that loves to plug these, let's assume these mortgages on these investment properties by deeding the property into this trust and all of that. Like, think about that. Like, now someone goes to sell that property at some point. Like, I know that you're very diligent in reviewing public records and making sure that the seller is the seller, but like that imagine what are the other chaotic things that can pop up there?
Yeah. It's there's a whole ton of it. And then when we look at so it comes down to trying to skirt the system is what all that stuff comes down to. And you're going to run into an issue, right? And I think, when I take a look at second homes or investment properties, for me, I feel like you need to have some money into that. You don't want to be super crazy leveraged. You never know what your life is going to look like in 2 years, or what the economy is going to look like in 2 years. And if you run into a situation where you need to be able to sell that place, you need to be able to sell that place.
That's a leverage on investment properties is a good one. So maybe a little bit out of my scope on residential, but I know that you work on commercial and some industrial stuff. These seller carrybacks and like all this other stuff, right? Like, everyone thinks it's a great idea, but you're still leveraged. Like, there's still a payment there. You still aren't picking up equity.
Yeah. So that's an interesting one. And it's funny. It's come up a lot on commercial deals that I've done. Is one of the things that we have to have a discussion with our commercial and industrial clients is, price. We have to take a look at, like, who is going to be able to qualify for this, because qualifying for a property like that is going to have even more strings attached, and it's a much smaller pool of people that will be able to make it through it. So what happens is it becomes tempting for the owners to say, well, I'll write a note to the guy. All right. Well, and many times we're like, well, then you're attached to the business. And if the guy's buying the building to operate your business out of it, so it's going to be his business, you really just attached yourself to that. You didn't get out of it. All right. And then as a private guy, if something goes wrong and you need to foreclose on that, it's even more difficult than it is on a house. A house, the guy just lives there. You can go find a place, you can do whatever. But when a guy's business is there and it's his means of trying to foreclose on that, it's going to be a nightmare.
Especially when you're probably in second lien position, because that buyer likely got a first mortgage from someplace. So you're in second lien position. The borrower is probably a limited liability company, so there's a lot of ways to rinse it. But like, you want to see like chaos. You guys know I love boating. Just like look up Tommy's Boats, and like they were really big into the wake boat industry.
Okay.
You can go on Instagram and see like all of these customers posting all of these pictures of their dealerships closed up with giant signs from the landlords about, hey, we kick these guys out type stuff. So like that's the type of chaos that goes on there when you're highly leveraged and the place decides they're just going to wash their hands of it because they're also highly leveraged.
Right. Well, so in one of the areas where this comes up, I think that we see a lot, at least I do. I don't know. It comes up in my feed for the last couple of years about buying investment properties with really little to no money down. And then you develop this cash flow. They're always pitching, well, it's the cash flow, right? And guys are leveraging this with some cash flow to pay that. Now this one's leveraged, everything. You only need a couple things to go wrong in that scenario and you're bankrupt.
And that's all of those things. They never talk about this, and you obviously you own investment properties. You've been in this a very long time. They don't talk about things like vacancy rate,
right?
Tenant turnover, all of these other things, right? So you talk about things that could fall out of line. Well, vacancy rate, like what happens if that property is not yielding cash flow for 4 months,
right?
And then that results in you not being able to make that mortgage payment and a different mortgage payment.
Yeah, my favorite one is, I don't know if you see it. There's this guy. He's a big dude. He's kind of like ghetto looking. He's got chains and stuff on. He's always flaunting the money and all of his bling and whatnot. And he was like, yeah, we buy a dumpy property for $35,000. We put $30,000 worth of work into it, and now it's worth $200,000. And we go to the bank and we get a loan on it based off of $200,000 for $175,000. We take that cash and then we go into this. Like, makes it sound like it's super easy. Like, you're not doing that. Like, they will look and see what you just bought it for, right? And within a year, we're going to go off of purchase price or appraised value, whichever is the lesser.
Pretty much. There's some ways around it, but yeah, I mean, and then the other part of that is on an appraisal, the appraiser is required to list any of the transactions on that property in the last 3 years. So
yeah,
lots of explaining.
So the things that are made to sound like a fast buck, and you're using other people's money, none of your own, like you're going to get rich. Like, you may, but there's a lot of moving parts to it, and you only need a few small things to go wrong, and you are going to end up in a really rough situation. So I think better off, one of the things we harp on all the time is to get a real plan together. What does it really look like? How do I need to budget so that I can be there and in these investment properties the correct way? All right. And covered. I've got cash flow figured out. I've got a vacancy rate baked into it. I'm safe, and it still makes money. Okay, that's a good buy.
Yeah, and sometimes they don't end up panning out. I know we have a mutual friend and maybe a teammate of yours, and we got a conversation with one of his previous clients about he's returning the property to market. It's just sometimes they don't check out, and you can get out of them, but you can only get out of them if you have enough equity to get out of them.
So appreciation, and a lot of these younger people, and the guy who put that deal together was younger. They've been operating in an environment of appreciation and large scale appreciation. Appreciation can save a lot of bad deals. All right. And we saw it prior to 2019 in the rehab business. A lot of people made a lot of money, not because they were good. I saw a lot of things. I'm like, this doesn't make sense. All right. Because the price isn't there on the end. Well, in the period of time between acquisition of the property and when it's hitting the market, there was such large scale appreciation that it saved them. But when things flatten, and we may very well be in a flatter environment for a while, you're going to have to take a look at those things a little bit tighter. You know, one of the things that I've looked at is, you know, what is the return? All right. What is the cash on cash return and whatever? And I found that in the last couple of years, cash on cash return on a lot of these properties in Northwest Indiana and in Chicagoland was 7% or less. All right. So, you know, you can write off expenses on a property, so that can actually increase that return a little bit. And you'll likely have some appreciation, so that makes those things a little bit better. But we've really had to weigh, where is your better move, in the stock market or some form of tax protected account there, or in the open market transacting on it.
Well, you can get a money market account right now yielding 4.5%, which is realistically risk-free. I mean, you're dealing with inflation a little bit there, but versus a 7% cash on cash return on a property that you have to maintain, get rent from. Where's that premium exist, right?
Yeah.
What else? Anything else on that?
No, you know, I mean, that's it. It all comes down to what we always talk about, which is like making a good financial plan. Things aren't free. If you're realistic from the front end, you can develop a good budget. You can know how to look at a possible deal and figure out whether it makes sense or not. Right. But if we've got pie in the sky, we're going to get rich really quick. We've got to cut a corner here. We got to do this, that, and the next. You're going to put yourself in a really bad spot. And now one of the corners that we've seen cut for years, which has been occupancy, all right, or what your primary residence is. And that one's getting cut out of the equation, or at least being policed right now.
That's it. Just OPM, other people's money. It comes with strings. It's gonna claw you back. Real quick, next Thursday, we're throwing a pretty big party for the people out in the region area. It's at the St. John Community Center.
Yes, it's very nice. We were there for the grand opening. It is right off of Klein. It's right off of Klein, which is pretty much the eastern border of the gates of St. John. Beautiful building. We have a band. We're going to be barbecuing some and serving up some refreshments and things for the people. And it's kind of just if you're in the region, you're invited. We'd love to see you.
That's it. Come get some beers, enjoy some barbecue.
It's Thursday, September 4th. And what time do we start?
I think like 6. They're drawing 6 to 10, maybe. I think the band around about 7 or so. I got Kona Ice going to be there too. So this is also a kid-friendly, family-friendly event.
Yeah. So bring the kids, bring your neighbors. We'd love to see it. It's just kind of like a meet and greet. Get familiar with your neighbors. Have a tour of the new community center, which is beautiful. And
it's beautiful. It's very, very cost effective. So if you have big families, you want to put on events, you live it, like super easy process to get it. So come check it out. You can bring your skateboard to the skate park over there. Do some kick flips or something too.
Not anymore. Not when I wake up and my ankle doesn't work, or one day I whack my hand on something and that doesn't. I think those days are behind me. But there is a nice skate park there. There's also a why can't I think of it? Pickleball court right there. That's pretty nice. So if you haven't been out to the new parks development over there, this is a great opportunity to come check it out.
All right. They can Google you, Tony Mitidiero, spell it right, spell it wrong. They'll get you.
Yep. 708-259-3734. All
right. You guys hit me up on applywithjr.com. Until next week, we're out.
All right.
I'm done. Cut the show.